I have lots of videos in the series that I create. They're all about basically the same thing. These videos are for comprehensive financial advisors who are seeking to work with higher level, ideal clients who are more successful, more affluent, clients who have more complexity and are willing to pay higher fees. There is a disconnect between financial advisors and clients, the way these clients think. And as you move up with more complex, more advanced clients, the disconnect widens. So let me talk about one issue, the disconnect, that it will help you in communicating better as you're interacting with ideal clients and potential ideal clients. It'll help you connect with them mentally, and being in sync with the client and the way they think is one of the keys to working with ideal clients. What am I talking about? In our business, at least the way I've set it up at my firm, when we are delivering truly comprehensive financial services, I've told my team, I tell my clients, we think in terms of 5 areas when it comes to personal financial issues. Clients got objectives. They share them with me. I explain to them that we're going to create a comprehensive written lifetime financial strategy covering 5 areas of finance in their life. We're going to look at financial planning. We're going to look at money management. We're going to look at tax planning, estate planning, and risk and safety. Risk and safety is the issue that I'm talking about. I think everyone listening to this would agree. Yes, of course, we need to look at the client's goals. We need to do financial planning. Money management, that's the investment management component of a client achieving their objectives. Tax planning, estate planning, I think everyone would agree that this is critical if you're going to deliver comprehensive financial services at a high level to affluent, ideal clients. But what about this other area? How do we think of that typically? Do we call it risk and safety? My experience, no. The way I always looked at it before I figured this out something like 25 years ago, we filled that category with insurance. So we've got financial planning, money management, tax, estate planning, and insurance, because clients have insurance. They have life insurance, they've got homeowners auto insurance. So we've got to understand what insurance they have and what protection there is for the plan in the event of what? Usually death. That's not the way the client thinks of this. The way the client thinks of this area of insurance is entirely different. For clients, it's risk, not insurance. I'm going to go through step by step what I mean here so that you can put together a framework for dealing with this and communicating effectively with ideal clients and potential ideal clients. Okay, so I've already outlined the 5 areas of planning. It's just this final area that we're calling insurance that I'm trying to transform that for you. What is the difference between calling it risk and safety versus just calling it insurance? So it's going to change the order in which you do your planning. You start the way you normally would start. You start with the area of financial planning, money management. You work towards the client's objectives and you put that plan together. You look at all the tax issues, the estate planning issues. You create the plan the way you normally would. But what do you do differently? Once you have the plan created, that's where you come in with the risk and safety. Now that there's a plan, it's a comprehensive written lifetime financial strategy that you've just created, you and your team, for this client. What is it that the client means when they say risk? Now that you have a plan, it's a separate process, and you roll right into it naturally. What you do once the plan is created is you and your team sit down, and if it's you alone, you do it alone. You establish what are the risks to this plan. You sit down and be very candid, very honest. I like to bring the client into this conversation. I don't bring them into the office, but I'll call them up. I'll tell them we're putting the finishing touches on your plan. We're going to sit down with you and go through this. But before we do, I know the issues that I think are significant issues related to your financial plan. But I'm asking a different question. I'd like to know what you think are the significant financial issues that might create either an obstacle to this plan or things that you're worried about that you want to make sure are covered in this plan. In other words, what could derail this plan in your mind? So I like to bring the client in, even if it's just a quick phone call before we set about to create the plan for risk and safety. The starting point is just having a list of risks that you, your team, the client all agree these are things that either could happen or that the client is worried might happen. And then you create strategies for each and every one of them. Next to each risk, you brainstorm what are strategies that could either mitigate or eliminate the risks you've now got as a list. You're in essence creating a separate strategy. Now that you have the plan created, you've got an additional portion of the plan to identify risks, mitigate them. Now the fifth component to the plan, which addresses risk and safety. So we've covered risk, we've got strategies. We're going to summarize all that in a comprehensive written lifetime strategy for risk and safety, where we put the plan together for reducing risk. But what is the client thinking of when they say safety? What the client really is wanting, I'm working off data here. So what I am saying is, this is what all clients are relieved when they hear exists, and that is, I've identified the risks that are the most relevant to your plan. We've created a strategy for each of them. We have now established a margin of safety. So you have a plan that creates the greatest probability that you can achieve all of your objectives, and now with a margin of safety in addition to that plan. So the client doesn't care about insurance particularly, but they do care that all the risks to their plan have been thought through, there's a strategy for addressing them, and this adds a margin of safety to their existing plan. But what about insurance? What happened to insurance? It exists. What are we going to do with it? I will just end this by saying insurance is a component of risk and safety. So yes, you need to evaluate all the insurance that the client has. You need to, in essence, look at all the insurances that a client could have, whether or not they have it, and sit down and establish which insurances they actually need. This is not an exercise to go through the planning process just for the purpose of recommending insurance. No, this is a plan to identify how to achieve the objectives, then build a plan for risk and safety on top of that, which establishes a margin of safety, which you go through this entire process. Each and every year you update the entire plan, including the margin of safety, and you keep working at it until you have every year met or exceeded the margin of safety from the previous year. And yes, in the process, you've gone through every insurance that they have. You've established whether they do or don't have the correct limits. You weigh in on what your recommendation would be as far as insurance, but just so far as making sure they have the insurance that they need, in your opinion, that you've reviewed all their coverages and they are set at the proper amounts. So I hope this helps. And keep in mind, clients don't care about insurance particularly, but they do care about risk and safety. We'll see you in the next video.